We've all heard the old saying, cash is king, right? That having stacks of paper currency tucked away is the ultimate symbol of having made it. But when we actually dig into the official data from the Federal Reserve, the IRS, and the Congressional Budget Office, a completely different, honestly kind of hidden reality emerges. The most financially successful people in the US, they don't treat cash as a destination. They treat it as a liability. So, welcome to our explainer on this massive paradox. To really grasp how modern wealth is built and kept, we need to uncover why the economic elite relentlessly avoid holding onto cash.
Okay, let's dive into this with a quick scenario. Imagine you suddenly wind up with $10 million. Ask yourself right now, how much of that would you keep sitting in a standard liquid bank account? Maybe half of it? A quarter? For a lot of us, the gut instinct is to stash a massive chunk in cash as a safety net, keeping it insulated from the wild swings of the stock market or a housing crash. But what do the ultra-wealthy actually do?
2%. Yeah, according to data from the Federal Reserve Bank of Richmond, the wealthiest 1% of Americans hold a mere 2% of their total wealth in liquid cash. That is a pretty shocking statistic when you think about it. For the economic elite, cash isn't a safety net at all. It's really just a transitional state, a temporary holding pen for their money before they deploy it into something actually productive, or they keep just enough on hand to cover immediate tactical liquidity needs.
And the contrast across the wealth distribution is incredibly stark. The lower middle class, folks in the 25th to 50th percentile, are holding anywhere from 11 to 15% of their net worth in cash. Even crazier, they hold up to 29% of their wealth in vehicles, which, as we know, are rapidly depreciating assets. But compare that to the top 1%. Like we said, cash is minimized to just 2%. Vehicles make up a tiny 1 to 2%. Instead, their capital is heavily concentrated in stocks at about 31% and business equity at up to 41%. So the middle class is holding assets that lose value or cost money to maintain, while the wealthy hold assets that actually generate cash flow. But why exactly are they so allergic to cash?
Well, the answer comes down to an invisible thief, and that thief is inflation. If we track the Consumer Price Index from the Bureau of Labor Statistics, we see this relentless structural upward climb. Back in 1980, during the quote-unquote Great Inflation, this index sat at 82.4. By 2000, it hit 172. By 2020, almost 259. And by mid-2026, it's pushing past 332. This isn't just a boring chart of rising prices. This is literally a documentary of the visceral decay of the US dollar over a 46-year period. Even during periods that economists love to call the Great Moderation, the purchasing power of our currency was just continually eroding.
To really put that into perspective, a single dollar from 1980 has fallen to less than 30 cents of purchasing power by 2026. Let's go back to that $10 million scenario for a second. If a wealthy person had just hoarded $10 million in a vault in 1980, failing to invest that capital would mean they'd have lost roughly 70% of its real-world utility today. The financial damage of holding fiat currency over the long term is absolutely catastrophic to wealth preservation.
The data points to one undeniable systemic truth. Inflation operates as a systemic tax on non-productive capital, diminishing the real value of nominal currency over time. For people with substantial net worth, keeping huge cash balances isn't playing it safe. It's a guaranteed mathematical loss in real terms. And with the persistent inflation of the 2020s, which the Congressional Budget Office notes has been incredibly sticky and tough to wrestle down to the Fed's 2% target, that carrying cost just gets heavier. So how do they shield themselves from this?
They use what we can call the asset shield, and it's heavily driven by Federal Reserve monetary policy. When the Fed lowers the federal funds rate, which they usually do to stimulate the economy during a crisis, they effectively lowered the discount rate. In simple terms, when this rate drops, the present value of future money generated by stocks, businesses, and real estate automatically inflates. Central bank policy has historically propped up asset prices during crises, creating this floor for asset owners that cash holders just do not get. Basically, idle cash gets punished, while productive assets get a massive valuation boost.
Historically speaking, U.S. equities have been the ultimate shield, giving investors about a 7% annual return after adjusting for inflation. While cash is just sitting there losing value, equity dividends have actually outpaced inflation in almost every single decade. And this brilliantly illustrates why massive corporations return value through share repurchases. Take NVIDIA's staggering $80 billion authorization in 2026, for example. It increases ownership stakes without the immediate tax drag of a cash payout. The end result? IRS data shows the top 1% captures an unbelievable 45.3% of all capital gains in the United States.
And all of this builds up to the absolute ultimate wealth driver, private business ownership. When we look at official data for S corporations, businesses owned by the bottom 50% trade at a multiple of roughly 4.9 times their raw operational profit, or EBITDA. But for the top 1%, their businesses command a massive 9.0 multiple. The economic elite don't just own businesses, they own businesses that the broader market values at a significant premium,
compounding their wealth way beyond what anyone could ever make just earning a wage.
This is exactly why business equity is often the single largest component of an ultra-wealthy portfolio, accounting for up to 41% of their net worth. The wealthy capitalize on their skills by straight up owning the means of production. Just consider this. In a single month, June 2026, the U.S. Census Bureau reported over 530,000 new business applications. The wealthy are the primary founders and funders of these enterprises, allowing them to capture the explosive returns of early-stage capital while actively dodging the drag of idle cash.
When you combine all of these factors over a long period, the mathematical divergence is just stunning. If you leave $1 million in cash, assuming a 0% inflation-adjusted real return, in 30 years, well, you still have a nominal $1 million. But we already know its actual purchasing power is completely shattered. On the flip side, if that same million is invested in equities yielding a historical 7% real return, it compounds into over $7.6 million. Think about that. That is a $6.6 million penalty simply for holding cash.
The Congressional Budget Office data points to this exact dynamic as a major driver of modern wealth inequality. It's a very clear cycle. First, the wealthy start with a larger initial stake. Second, they have a higher propensity to save and immediately deploy that capital into productive assets that yield higher returns. And finally, the compounding effect takes over. Because they earn more on their investments, say 9% versus 7% thanks to their scale and access, this creates an unbreakable mathematical lead over anyone relying purely on wages and cash savings.
So the fundamental takeaway here requires a complete reframing of how we think about capital. Wealth is not stored in cash. It is grown in productive assets. The strategic minimization of currency by the top 1% isn't just some weird quirk of the rich. It is a highly sophisticated, absolutely crucial survival mechanism. It's designed to navigate a fiat economic system where currency is literally designed to depreciate over time.
As long as macroeconomic policies prioritize stabilizing the financial system over protecting the purchasing power of the dollar, this playbook is going to remain the absolute gold standard for capital preservation. Which leaves us with one critical, lingering question to consider about our own financial strategies. Are you storing your wealth in an invisible trap, or are you growing it in a productive engine?